and today we're going to talk about multifamily bridge loans and what options you have available for you. Many factors play into what type of bridge financing is available, but there's a ton of bridge capital out there. We have some super aggressive bridge capital, meaning they'll go to 75% of the stabilized value. So really, you can come in with very little cash out of pocket, with less sponsor equity into the deal. So that might be the goal you're looking for, depending on your capital stack structure. So food for thought, lots of options out there. I'm constantly exploring the different options and always looking for better ways to fund properties. If you want to talk about a property you're looking to buy, refinance, book a call below.
Welcome to the Investor Financing Podcast, where we interview real estate investors and lenders so you can learn all the secrets to getting your projects funded and scale your portfolio. And now, your host, Beau Eckstein.
Hello and welcome to another episode of the Investor Financing Podcast. And I'm your host, Beau Eckstein. And today we're going to talk about multifamily bridge loans and what options you have available for you. So it really comes down to the property type, the location, the sponsor's experience. Many factors play into what type of bridge financing is available, but there's a ton of bridge capital out there. We have some super aggressive bridge capital, meaning they'll go to 75% of the stabilized value. So really, you can come in with very little cash out of pocket, with less sponsor equity into the deal. So that might be the goal you're looking for, depending on your capital stack structure. But for heavy value add deals, that's available, where you can go 75% stabilized value, gross loan amount, up to 75% of stabilized value. That program's a little bit more expensive because you're getting very high leverage, right? The riskier the leverage amount, the more expensive the capital is going to cost. And then we have high level bridge financing, and that's for these larger $10 million loan requests for really strong sponsors that just need to take down a property quickly for whatever reason. It's just a little bit off of where they need to be to get agency or HUD financing. Maybe the occupancy is a little bit lower. And those type of loans, you can get very, very attractive terms in the low fours on bridge debt. But the gamut of bridge financing can be anywhere from the low fours to the mid sixes to the mid sevens to 9, 10, or 11%. It really depends on the deal itself. The smaller bridge deals are usually more expensive debt. There's not as many funds funding those smaller deals.
You're listening to the Investor Financing Podcast. We'll be right back after this break. Are you looking for funding? Are you getting frustrated trying to find a lender? Visit investorfinancingpodcast.com and click the Get Funding button. Complete the simple form and schedule a free phone consultation with one of our placement specialists. We have a proprietary directory of funding partners that can help you get the funding you need. It's fast and easy to explore the options available for your specific needs. Don't wait. Visit investorfinancingpodcast.com and get connected.
So it just really depends. So it's the sponsor's experience, for one. Do they have a lot of experience? Is this their first deal? Is there options? That's what we got to look at to figure out what debt options are available. And then at the end of the day, they're really scrutinizing and looking at the property itself. What's the value add component? Is there any caveats with deed restrictions or anything? Is it in a crime-ridden area? Is it the vacancy extremely high and it's just that overall area vacancies are very low? Those kind of considerations in the different submarkets or tertiary markets play a big role on available capital for that. If it's an A market, if it's a very old property. The characteristics of that play hand in hand as well. But that being said, it's quickly, usually by a discussion or two, you know exactly what key bridge lenders will be looking to fund that deal. And there's also bridge lenders that underwrite to the stabilized product, meaning bridge to agency or bridge to HUD. And so they're looking at it from the bridge perspective, but also they're doing like a secondary underwrite, saying yes, upon stabilization, it's going to meet our metrics to fund Fannie, Freddie, HUD. So that's the other way you look at it. But lots of different options out there, and even unstabilized properties, sometimes you're able to get bank or credit union debt on that property, even though the occupancy level might be 70 or 75%, where historically stabilized properties are 90% or greater with agency standard underwriting. So food for thought, lots of options out there. I'm constantly exploring the different options and always looking for better ways to fund properties. If you want to talk about a property you're looking to buy, refinance, or just looking for some general ideas on what other opportunities might be around for financing, book a call below. As always, thanks for watching, and we'll see you on the next episode.
Thanks for listening to the Investor Financing Podcast. For show notes and useful resources, please visit investorfinancingpodcast.com. For questions or comments, email info@investorfinancingpodcast.com. If you enjoy our show, please share it with your network. Until next time.